Hi, my name is Luke Flanagan. Thank you for joining the Fidelity Fixed Income webinar series. I'm an investment product director for Fidelity. In my role, I support a broad suite of investment grade and high yield mutual funds, ETFs, and institutional products. Most relevant for this conversation, I support our core fixed income ETF offerings. There's a lot going on in the world of fixed income today. We have a Fed meeting going on right now. We have a presidential election upcoming this fall. Yields are up, spreads are tight, and the economy is chugging right along. But uncertainty still hangs in the air. So with that, the plan today is to try and cover as many topics as we can in the short time that we have. We have a set of prepared questions and topics, but we want to make sure this is as relevant and timely for those listening. So please do submit your questions with the Q&A tool that you have on the right-hand side of your screen. I'll make sure as we hit as many questions as we can. But before I go any further, let me introduce our main speaker. Today, I'm joined by Michael Plage. Mike is a portfolio manager for the core bond team here at Fidelity within our fixed income division. Prior to his current portfolio management responsibilities, he's a portfolio manager on the corporate bond team here at Fidelity, and he managed funds similar to the corporate bond ETF. Prior to that, he was a trader within our fixed income division, and Mike is named on all of the ETFs that'll be coming up on this page. And quickly, I just want to highlight what these funds are so that folks can understand what the diversified investment universe, which Mike is investing in every day. So on the left-hand side of the page, we have the Fidelity Investment Grade Bond ETF. This is primarily focused on investing in core investment grade exposure. This includes US Treasuries, agency debt, corporates, and securitized assets such as mortgages. The fund keeps its duration mostly in line with the broad-based benchmark, the aggregate bond index. In the middle, we have the Total Bond ETF. This is our flagship fixed income ETF. It invests in all the same exposures. Plus, it has additional flexibility to invest up to 20% in below investment grade sectors such as high yield corporates and more emerging market debt, leverage loans, and high yield commercial mortgage backed securities. The Fidelity Total Bond Fund ETF is the largest managed ETF within the core and core plus ETF space, and it's gold rated by Morningstar, along with the mutual fund and the investment grade bond mutual fund. Finally, on the right is the most flexible product in the core bond lineup. This is the Fidelity Tactical Bond ETF. While this fund follows the same investment process as the other two funds, it has the greatest flexibility to lean into portfolio managers' best thinking and evaluation of relative value, given the flexible mandate. This ETF has even greater flexibility to invest in below investment grade securities and has the widest band on duration. With this ETF, returns tend to be slightly less diversified from equity markets compared to investment grade bond. However, the fund seeks to provide a volatility profile that you'd expect from an ETF benchmark to the aggregate bond index. This is the fund where Mike and team could lean into the most heavily into the areas like leverage loans or high yield, as highlighted on this table. So Mike, now that we understand your background and the funds that you work on, I want to dive right in. Let's start big picture. What's your view on fixed income today?
Thanks, Luke, and thanks for having me. I appreciate it. I love fixed income. I think since the reset of yields in 2022, we actually wrote a white paper at the beginning of last year entitled "If You Don't Love Bonds Today, You Probably Just Don't Like Bonds." And the supporting data and the research behind that was primarily driven by yields that we hadn't seen in the fixed income market in almost 2 decades. So we kind of tongue-in-cheek joke that there's income back in fixed income, but it's true. After a 15-year period of near zero interest rates, the Fed hiked rates 525 basis points, and with that, yields across all fixed income asset classes rose. And the best starting point for projecting future returns in fixed income is yield. We've had a period of positive correlation between bonds and equities. I think that's coming to an end as the Fed has gotten inflation back under control, and inflation and the Fed start being less of a contributor to fixed income market volatility. That correlation should revert to a more normal negative relationship. And I think that's where we are today. So the two primary drivers are historically high yields, at least in the last 20 years or so, across fixed income asset classes, and better diversification than we've seen in quite some time. So yeah, I'm excited about the fixed income market. I'm excited about active management relative to kind of passive building blocks. I'm excited that there's lots of money, parked in the front end that I think should probably move out into duration space. So there's a lot to like in the bond market.
So Mike, you mentioned yields in the fixed income market, and I just don't want to bury the lead here today. I think the thing that's top of mind for everyone is that there's a Fed meeting going on. What should we be expecting to hear from Powell today? Is the Federal Reserve continuing to signal rate cuts, and what's the market expectations for the results of the meeting today?
Yeah, so of course we're having this webinar on the day of a Fed meeting. Maybe we should have done it at 2:30, and we could have done a live play-by-play of the press conference, which is always interesting. By the way, there's not going to be anything at 2 o'clock. The Fed's not going to move today. If it was not priced into the market, the Fed is not going to surprise the market by doing something that the market's not expecting. The market is expecting the Fed to remain on hold where they've been since last July. And the market is expecting a cut in September at the meeting following today's meeting, skipping November and then moving again in December. So 2 cuts for the remainder of this year. I tend to agree with that. That's what's priced in. And again, in an effort not to create volatility in the fixed income markets, the Fed's job is basically to use their words to tell the market what they're going to do without telling them what they're going to do. Have the markets price that in to the futures market and then deliver on that. And I think that's what we'll get in September. The Fed will tell you that they're still very data dependent, but they're encouraged by the recent CPI data. The inflation data is coming down towards their 2% target. He'll tell us that they're not going to wait until inflation gets to 2% because inflation has momentum. And if they wait until inflation is actually at 2%, they've probably waited too long. And they are trying to continue to thread the needle. They are looking for a soft landing. So I think Chair Powell, being a pragmatist, does want to cut maybe a little earlier than he needs to. People would argue that he should have already cut. But we did get those 3 high surprise inflation prints in the market. So I think he's a little bit gun shy in terms of promising cuts, but I think if you read between the lines today, you're going to hear a Fed that is expecting 2 cuts over the course of the rest of 2024. You'll also hear the Fed and Chair Powell talk about risks being balanced. In the 2 risks that he's talking about are inflation risks and employment risks, the dual mandate. And with the unemployment rate ticking a little bit higher, I think the employment picture has become a little bit more of a focus for the Fed, and they've taken their eye off of. I think they're pretty comfortable with the inflation picture at this point, and they're watching the employment picture very closely. And you'll hear them say that employment is no longer a source of inflation. So that's a sign that the Fed is pretty close to cutting, and I think we'll get that not at this meeting, but in September.
Okay, so let's dive into the economy. You kind of talked a little bit about kind of the employment picture, but could you take us through kind of company and consumer fundamentals and what you're seeing for the overall backdrop of the economy?
Fundamentals are still really, really strong. So you could make an argument that the Fed doesn't need to cut at all because the speculative grade default rate in corporate bonds is still 3%. That's up from 1.5%. So maybe the trend is a little bit negative, but the absolute default rate in corporates is still really, really low. Balance sheets are really strong. Remember, corporates shored up their balance sheet in 2020 and 21, issued debt and kept that cash on their balance sheets. Now earnings have rebounded, so leverage is very manageable in the corporate space. Our earnings season, we're kind of most of the way through earnings, second quarter earnings at this point. Something like 80% of companies are beating expectations. That's a pretty good earnings season. So the fundamentals in corporates are still very strong. Problem is valuations reflect that. In corporate bond spreads, and we'll talk about it later, are priced for perfection. The consumer is also very strong. Now, the higher socioeconomic cohorts of the consumer are doing better than those lower cohorts, and you start to see the impact on some earnings as a result of a little bit of stress in the lower earning cohorts of the economy. McDonald's, for example, Starbucks, have seen a little bit of a hit. We hear it from Walmart, Target. So we're keeping an eye on that. But the majority of the consumers in the U.S. are still in really, really good shape.
Thanks, Mike. That's great and helpful context. You kind of talked a little bit earlier about Powell's goal of kind of threading the needle. I've worked with the team over the past few years, and I've seen you and the team members kind of consistently holding this base case that the economy wasn't headed for a hard landing. With all that you've kind of been talking about, is that still the case? Is there potential for a soft landing on the horizon?
The soft landing is the base case. When everybody who wants a job has a job, employment at 4.1% is obviously a really strong economy. Powell characterized that as back to where we were pre-pandemic. Strong but not overheated. So we're in a very strong. We have a very strong employment picture. Mostly everybody who wants a job has a job. It's hard to have a recession or a significant recession when that's the case, near full employment. And again, like I said, earnings are still strong and balance sheets are not overextended in the corporate world. So, the consumer leverage is not extended, the corporate leverage is not extended. If anything, I think we see a slowdown, not necessarily negative growth, but maybe a slowdown in real growth to kind of 1 or 1.5% without dipping down into recession. But when you're that low, anything can happen. We are kind of at the cusp, but it's also hard to have a recession when the Fed is actually starting to become less restrictive. And I will differentiate too, and Powell has done the same. The Fed is not cutting to stimulate the economy. They want to be very clear that the Fed is cutting to become less restrictive. When the Fed is cutting to stimulate, I think that's a different picture. That's more of a hard landing scenario. They see something in the data that would indicate a higher probability of a recession. That's a little bit more worrisome when it comes to the economy. We could get there, but still our base case is a soft landing.
That makes sense, and I do think that's helpful context. So in the market more broadly, we've seen a lot of volatility. How are you thinking about the volatility going forward, and are we seeing the benefits of maintaining a diversified portfolio today? Specifically, it'd be great to hear you touch on the fixed incomes kind of correlation equities and whether that's kind of coming back into play.
Yeah, so first on vol is directly related to the level of rates. As long as rates are high, our expectation would be higher levels of volatility as measured by, say, the MOVE index. So fixed income volatility. I'm not talking about the VIX here. Yet the MOVE index and fixed income rate volatility should remain high, particularly as the Fed is on the move. And even though we've been stable in terms of monetary policy since last July, rates being high and the speculation from the market on what the Fed's next move would be has kept volatility high. So I think vol stays a little bit high, starts to trend lower as the Fed starts to ease, but that remains to be seen. I think a diversified portfolio at this point in the cycle is really important. We are probably going to see pockets of weakness here and there. It's really hard to predict where those pockets are going to be. So if you maintain a diversified portfolio and you're liquid and you're nimble to react to those periods of episodic market volatility and take advantage of idiosyncratic opportunities, that's a situation you want to be in. So we'll talk about positioning probably in a bit. We're pretty diversified at this point. We've got lots of dry powder to add as we start to see some weakness in certain areas. And then finally, I mentioned it earlier, the equities and fixed income, just take the S&P 500 and the 10-year Treasury as examples, have been positively correlated as the Fed has been reacting to higher levels of inflation. When the Fed is inducing volatility, stocks and bonds can be correlated, which is a problem when stocks and bonds are both going down. When stocks and bonds are both going up, I don't hear as many complaints, but I do think that we're getting to a point where if there is a problem in the equity market, we've seen kind of the Mag 7, the NASDAQ sell off quite a bit. Fortunately, it's been buoyed a little bit by a broadening out of the strength in the equity market. But if we do see weakness in the equity market, the yield on the 10-year Treasury, even at 4.10, where we are today, still has a lot of room to run to provide some ballast within a stock and bond portfolio. I think the 60-40 balanced funds, I think, are still, they've been proclaimed dead. I don't think that's the case. I think that's still an important product and a reasonable way of expressing diversification within the fixed income and equity markets.
That's helpful. Thanks, Mike. So kind of continuing on the topic of volatility, one of the I think the biggest drivers of volatility that we kind of hear about is this upcoming presidential election. It's a topic folks are really keen to get some insight on. Can you talk to me about what you've identified for as risks as far as the presidential election, and what investors should be listening to or not thinking about as far as the presidential election goes?
Yeah, I've been doing this for 25 years. I think politics is probably one of the hardest factors to invest around. This election, every election seems like it's going to be the hardest, election to invest around. I think, that holds for this election as well. I don't think you should position portfolios around election results. I think it's an exercise in futility. I don't trust polling numbers. I think if you invest around polling numbers, even the betting sites, I think you're going to be sorry you did at some point. You have to remember, and I'll just, so we're not investing around the election. We'll react to the election results when we get them, but we're not going to invest in advance of the election results. If things get really out of whack, maybe there's an opportunity to lean into something, but we're not calling the election. We're not investing around the election results. I do want to caution everybody too. Remember, we're going into full campaign season at this point. You're going to hear a lot of promises. You have to differentiate between campaign promises and what's delivered in terms of policy during an administration. And those things are very different. Sometimes they're in the same direction. Sometimes they're not, but they're almost never of the same magnitude as what you hear in campaign promises. Take tariffs, for example. 60% tariff on goods imported from China, all of them, 10% tariff across the board. That has a very low likelihood of becoming policy. So, to the extent that the fixed income market sells off and inflation expectations rise as a result, that might be something to lean into. So again, differentiate between campaign promises and what you expect to be policy in the event that a certain candidate wins.
Thanks, Mike. I think that's a great clarification. So I kind of want to dive a little deeper into the way you're positioning the portfolios, and I'd love to hear your perspective on some of the sectors with how much overall risk you're taking. But before we do that, we're getting a few questions here, and I would encourage everyone to jump in and ask questions because I have it up here on the side of my screen. But we're getting some questions about are the funds that you manage actively managed funds, and do you see any benefits around active versus passive management? And I'd love to hear about how you're thinking about the opportunity set there.
Yes, all of the funds that I manage are actively managed, and to some extent, we are trying to outperform a benchmark. In this case, the aggregate bond index, the Bloomberg Aggregate Bond Index, and in some cases, we're less tied to that benchmark. For example, in our tactical fund strategies, FTBD, but they are all actively managed strategies. They've got various levels of alpha that we're trying to achieve. All have volatility in line with that of the benchmark or the aggregate bond market. But we are trying to outperform, generate additional alpha above and beyond that of the market. And we do that in a number of different ways. I don't think we have time today to go through our 5-step process, but we do have a 5-step process that we use in every market environment, in every part of the cycle. And in fixed income, it starts with the macro environment. The first 3 steps are macro, sector, and asset allocation. And the reason we do that is that's where the opportunity set is in fixed income. If you look at all of the fixed income asset classes going back in time, there's at least 10% and oftentimes 25% difference between the best performing fixed income asset class and the worst. And a passive strategy will buy all of the asset classes. And we try to identify the asset classes that will be top performers and overweight those, try to identify the asset classes that will be the bottom performers and underweight those. Sometimes some asset classes in fixed income have positive returns, others have negative. Sometimes, like 2023, all fixed income asset classes had positive returns, but there are some asset classes like loans, which outperformed, versus other asset classes like mortgage-backed securities, which were positive, but much less so than the loan market. So that's the idea behind active management. We can go to as much detail as you want about that.
Thanks, Mike. That's helpful, and I think you answered some of the questions we've been getting. So with that, I think you kind of started to talk about some of the sectors. Maybe we could dive in. I think one of the most common sectors that I think a lot of folks out there will be kind of keen to hear about is the corporate positioning that you have in your fund. It's about a third of the index, and I'd love to hear how you're kind of thinking about corporate positioning overall, what's happening in the corporate market. I know spreads have been kind of tight, but I'd love to hear your perspectives there.
Yeah, I think kind of tight's an understatement. Corporate bond spreads are at the all-time tights in my view. There's very little value. Like I said earlier, corporate bonds are priced for perfection. You'll hear a lot of people talk about liking the corporate bond market, and what they really like is the yield. And where does the yield come? It's treasuries. It's the underlying treasury yield, not the additional spread you get for owning corporate bonds. So, my view is at 80 basis points over for investment grade credit, and not to get too much in the weeds in terms of bond math, but a 7-year duration, the 20-year average spread is 130 basis points. If corporate bonds just return to the median over that time period, 50 basis points wider times a 7-year duration, corporate bonds are going to underperform treasuries by 350 basis points. That's over 4 years of additional income you earn by owning investment grade corporates relative to treasuries. So said differently, if investment grade corporates return to the median at some point in the next 4 years, you're better off sitting in treasuries and waiting for that opportunity. And that's where we are today. Our corporate bond exposure is an idiosyncratic risk. Ideas that our analysts, who are all sitting on the trading floor behind me, have come up with. They're turning over stones back to the Peter Lynch model. Whoever turns over the most stones generally wins. We're looking for ideas. We try to skew the beta of our corporate exposure to be high beta in a rally, low beta in a sell-off. That's the idea. That's our corporate positioning today. But generally, we have less credit exposure today across all of the funds than we have in the last 20 years or so. Similar positioning to where we were in 2019. Now, we didn't know what was going to cause volatility, how spreads were going to go from the all-time tight to the median or beyond. We certainly did not anticipate a pandemic or a global economic shutdown, but months later, that's what we got. That was the opportunity for us then to reallocate the funds, sell down our treasury positions, and then go buy corporate bonds and anything else that wasn't nailed down in the risk sectors. That's kind of how we're positioned today. So low exposure to corporate bonds, and about the heaviest exposure we've ever had to treasury securities. And within treasuries, we like the belly of the curve, which means 5 and 7 and 10-year treasuries at the expense of 2-year and 30-year treasuries. Because we don't use leverage, we're not using derivatives to a great extent, and in a basically long only, easy to understand portfolio. That's how we're trying to take advantage of what will eventually be a curve steepener. As the Fed starts to ease, that curve should steepen out, and the belly of the treasury curve should outperform.
Thanks, Mike. You talked a little bit about corporate and your treasury positioning. Can you talk about the kind of the last big position is the mortgage and the securitized sector, and how you're kind of thinking about that overall and what your outlook is?
I'll separate the mortgage and securitized sector. And again, I don't want to go too far down in the weeds, but the mortgage-backed security sector that I'm referencing is the agency mortgages, Fannie, Freddie, Ginnie, kind of pseudo government guaranteed mortgage-backed securities market. It trades very tight. The Fed is a big owner. I think they like to be a less big owner. So as the Fed starts to wind down their balance sheet, eventually they like to own no mortgages. So mortgage-backed securities still have headwinds from the technical, the fact that the Fed owns them. It's a negatively convex asset class, and spreads are relatively tight. Now, on a historical basis, mortgage spreads have been much tighter than this over the last 20 years. They're not at the all-time tights. However, we still don't think there's enough relative value for us to be overweight. So although we've covered some of the underweight in mortgage-backed securities, we still remain underweight the asset class. It's just an opportunity. The opportunity set in mortgages is relatively low from our perspective. We still try to take advantage of idiosyncratic risks, certain stories within coupon stack. Again, not to get too technical, but there are some opportunities within mortgages. Tactical bond, I'll just say we have no exposure to agency mortgages at all. It's kind of no man's land for us. We tend to own Treasury securities and then riskier securities like certain parts of the securitized market, corporate bonds, high yield bonds, loans, emerging market debt, that sort of thing. And mortgages just kind of fall into the middle, into no man's land. So no exposure there. Now that's agency mortgages. Securitized, there are certainly some opportunities in securitized. We like certain sectors within asset backed. We like for our core and core plus funds, AAA CLOs have been an outstanding contributor to excess returns. AAA CLOs are the topmost part of the collateralized loan obligation structure, and really, really hard for us to envision taking a loss on that part of the capital structure. And you still are compensated spreads that are more than twice what high quality corporate bonds would provide of similar duration. So still a really attractive asset class, but only exposure again within the core and core plus funds.
Thanks, Mike. You talked a little bit there, kind of towards the middle, a little bit about your plus sector exposures. As I mentioned kind of earlier, the teams kind of had this base case that the economy wasn't headed for a hard landing. And given that base case, seems like in the core plus and tactical portfolios, Fidelity Total Bond ETF and Fidelity Tactical Bond ETF, we've kind of kept some of that high yield over the past few years. Has that changed in 2024? I know you kind of talked about a strong economy. Is that changing your positioning, or how are you kind of looking at those plus sector, high yield plus sector going forward?
Yeah, so we tend to be gradual contrarians across the board. So when there's an asset class that's underperforming, we tend to lean in and buy it. We're not trying to pick the bottom. We're just trying to capture value when the value presents itself. Conversely, when either risk asset classes or yields are presenting an opportunity to sell, we'll lean into that, and we might be a little bit early. Again, not trying to pick the bottom. And that's what we've done. We've reduced our exposure mostly to the loan sector. And just know that the tactical bond ETF doesn't own loans. At some point we will, but it's a relatively new and small fund. But our tactical bond mutual fund does. And we've been reducing our exposure to loans across our more aggressive, actively managed funds. For example, the tactical bond funds at one point had 20% loans. We're down to closer to 10% today. Why? Because loans have performed extraordinarily well. It's been the best performing asset class going on 4 years in a row, really post-pandemic. And loans now trade close to par. So there's really no prospect for capital gains, or at least meaningful capital gains within the loan market. And what you're left with is carry, which is the interest income you'll earn, which is still compelling, which is why we still have a loan position in the portfolios. So the loan coupon is probably coming down for a number of reasons. One, it's a floating rate asset class, and the coupon is tied to the Fed. What the Fed does, it's actually SOFR, the floating rate index. So as the Fed is cutting, the coupon rate will come down. And loan issuers are refinancing their debt, and they're saving money by issuing debt at lower spreads relative to SOFR and taking out the debt at higher spreads relative to SOFR. So even though loans have done well, they're less attractive today. And again, being in the spirit of being a gradual contrarian, we're selling down loans and buying actually Treasury securities again in the belly. So we're in terms of plus sectors, Luke, we're as light as we've ever been. We're still trading risk from the long end. Just know that. We still have a positive carry advantage relative to benchmarks, but we have lots of room to add, lots of dry powder if and when we eventually get those episodic opportunities that I mentioned earlier.
Awesome. We're getting a lot of good questions, so I want to give us some good time to kind of lean into that. But I've got a few more here before we do. And the next topic I wanted to kind of talk about is your areas of concern. I think one thing that has been kind of making the rounds in the media is the commercial real estate and probably the office segment. Could you talk a little bit about what the outlook is there and how you're viewing that sector?
It's not a new topic. The commercial mortgage market, and when you say commercial mortgage, you're talking about office properties, right? There's certain office properties that are not in great shape. A lot of that exposure is held on regional bank balance sheets. So the regional bank issue is a potential problem. The Fed knows it. I think Powell mentioned it in his testimony to Congress just a couple of weeks ago, right? Not a new issue. We know that the commercial office exposure is on regional bank balance sheets. It's in some commercial mortgage-backed securities as well. The benefit of having a big research organization with lots of people focused on the collateral for the securities that we buy is that we're able to scrub that data and make sure we're buying the cleanest structures that we can find, which means central business district, trophy properties, office properties with high occupancy rates that we would expect to remain high occupancy rates, and we're able to avoid, the Class B office properties, which maybe don't have occupancy rates even close to 70 or 80, 90% today, and really have no prospects for that. So that's the sector that's in trouble, and we're able to, we've been able to steer clear of that sector and have no plans to buy on weakness. So that's one area that we have no plans to be gradual contrarians, buying the office property that we think may be left for dead in some cases.
Thanks, Mike. So one question we're getting in here is actually a question that I wanted to ask you, and that's talking about extending duration, and just about, I think in some of your funds you have some more flexibility, like the tactical bond ETF. Can you talk about which clients should be thinking about when it comes to duration and the risks associated with, extending duration, and then talk about the timing now, if it starts to make sense to kind of pull some of that cash that's probably sitting on the sidelines and move it into kind of duration products like what you manage?
Yeah, so first let me preface by saying I'm running long duration across all of the strategies, which means I have more, and by duration, just to be clear, duration is a measure of interest rate sensitivity. So by saying I have more duration, what I'm saying is I have more interest rate sensitivity than my benchmarks, which is also to say if yields continue to fall, I should outperform those benchmarks because I've got more sensitivity to falling rates. That's a good thing given my positioning. So what does that tell you? That tells you that I still think a 4.10 10-year is an attractive entry point. I will also tell you that I have very little cash in the portfolios, and now the investors that are sitting in 5.25% cash, I think is a great returns, 40 basis points per month. But if you go back to just November and December, the bond market was up 8%. So that's the opportunity cost of sitting in cash, is missing rates as they fall. And as we've discussed, we're going into a Fed cutting cycle, which should benefit potentially fixed income securities across the curve. There's a capital gain opportunity if you own longer duration, longer maturity securities. There is no capital gain opportunity if you're in, say, a money market fund. Now, if you need the liquidity, that's great. But the money market fund, remember, at 5.25%, that's an annualized overnight rate. You're not guaranteed that rate over the next 12 months. That's an annualized overnight rate. And if the Fed, cuts in, if they cut today, that rate's going to go down by 25 basis points, more or less. And if they do cut 50 basis points by the end of the year, you're no longer earning 5.25%. You're probably earning something more like 4.75% for the remainder of the year. So the returns on money markets will be less than the yield, the annualized yield that you're looking at. My view is I think now is still a very good time to extend duration. at least out into the, 2, 3, 4, 5-year part of the curve. You can lock in some higher yields, and you have some exposure to, some opportunity to generate some capital gains if and when rates fall, out the curve. And again, that's, don't take that as investment advice. That's how I'm positioned in the portfolio, and think about that more as investment strategy when it comes to our actively managed core funds.
Thanks, Mike. So one of the questions we've just been getting is, we've talked a little bit about Fidelity Tactical Bond Fund, FTBD, and we compared it to a little bit FBND, so the Total Bond Fund. And so they were asking for a little bit of positioning differences between the funds, and why, and like how those could look different for someone who might hold the fund. But I think it'd also be beneficial to kind of talk about the value of having those plus sectors, and the flexibility that tactical bond has versus a kind of traditional core strategy.
Okay, I'll answer all of those questions, but first maybe start with, since Tactical Bond Fund, FTBD is new, not widely known. The Total Bond ETF is the flagship fund. It's our flagship fund. It's well known. It's seen tremendous growth. It's a $10+ billion ETF now, versus the Tactical Bond Fund, which again is just starting out. I really like the tactical bond structure. We have a lot of flexibility. It can be 0 to 65% in plus sectors. Total bond can be 0 to 20%. Today, the tactical bond ETF looks a lot like a core plus fund. So we're at 20% in high yield, just over 20% in high yield today. So lots of room to add. Total bond is more like 10% in high yield. If and when spreads return to the median or wider, as we discussed earlier, Total Bond has the flexibility to add about 10% in below investment grade securities, where Tactical Bond can add up to, say, 30%, given that 55% is the peak that we've been in our institutional strategies over time. So even though we've got a higher limit, in reality, we've peaked just above 50%. So lots of room to add when the opportunity arises in the market. When the opportunity is not there, Tactical Bond, we pull in the risk, and we look a lot like Total Bond. So again, the DNA for FIGB, FIGB, the core fund, for FBND, the Total Bond Mutual Fund, a core plus strategy, and for Tactical Bond, FTBD, the DNA is the same. The overall level, the direction of risk is the same. But the expectation for, I'll talk about 2 factors. One, returns. My expectation is returns in the tactical bond ETF should be higher over time, followed by FBND, followed by FIGB, because we have more levers to pull, more ability to take risk, more opportunity to generate returns. The volatility will be a little bit higher, commensurate with that level of risk. However, on the other side, in terms of diversification benefit, FIGB is going to be the best diversifier. It's the lowest risk product. It's a true core product. It's going to be the best diversifier. Again, in a drawdown in the equity market, my expectation is FIGB would be the best performer for some shorter period of time, followed by Total Bond, followed by Tactical Bond. So that's the continuum. That's what we call the continuum. I think there's a level of return and a level of risk for everybody. Again, they're managed by the same team. We have the same exact philosophy. We use the same 5-step process. The level of risk within the portfolio, the asset allocation decisions within the portfolio. If we like corporates, we'll be overweight corporates across the board. I've talked about mortgages, underweight mortgages across the board. So the direction of flight and positioning is the same. The magnitude of the bets is just a little bit different.
Thanks, Mike. I think that's really illustrative. So we're getting a lot of different types of questions. But one question that actually came in is, you talked a little bit about your process, your 5-step process before, and folks are keen to actually hear about the last few steps of that process. So maybe quickly just take everyone through what your 5-step process looks like, and how you use the resources here at Fidelity.
Okay, that's great. I can do that in 3 minutes or so. I will start with the first 3 steps because they're important. Macro. This is where we work with our macro team. I just was talking to Kana Norimoto before I came in here. She's our head of the macro team here in Merrimack. she is focused on the Fed and the Bank of Japan. So she's got a lot on her plate right now. I'm excited to talk to her after the Fed meeting and get her take. She is helping us understand monetary policy around the world. Where are the opportunities? What is the Fed's reaction function? This is the team that helped us in early 2020 understand the Fed's reaction function and the put that they put into the market, and gave us the confidence to go buy lots of credit at that time. So again, starting with the macro, how much return is available in the fixed income markets, and that drives how much risk we want to take in the funds. So start with macro, and she's got a whole team underneath her, and there's also a team in Boston that helps us evaluate macro. Got Aditi Balachandar is here. She's working on inflation. What is the trajectory of inflation? Again, then back to Kana, what's the Fed's reaction function to Aditi's forecast for inflation? Those are the types of things that we're working on at the very beginning. Sector is step 2. So this is where I'm talking to sector specialists I'm talking to Eric and Kevin and Chandler on the loan team and Ben and the team on high yield. Here in Merrimack, I'm talking to Matt and Jay on investment grade credit, Franco and Sean on mortgages. I want to know, do you love your sector? Is it a great beta opportunity, or is it ripe for spread dispersion, idiosyncratic opportunities? Start to think about where I want to allocate risk dollars. Step 3 is a more quantitative approach. It's asset allocation. This is where we're looking at the return opportunities across asset classes, but also the correlation among those asset classes. And we start to model the portfolios out through scenario analysis. We've got a risk-based platform here that we've developed over the last 20 plus years as a collaboration between our quants and our PMs to help us actually size the bets in the portfolio. So at this point, we've got a kind of model where we want to be. We've looked at the overall macro risk. We've identified sectors we want to buy, and we've sized those sectors through asset allocation. And we try to be as transparent as possible with our clients. And we talk about those 3 steps all the time, so people know exactly what they're rooting for when they buy our funds. Step 4 in the process is where we flip, and now we go bottom up. This is the Peter Lynch model. If you talk to any of our equity portfolio managers, this is what they're focused on: finding great securities, turning over stones, looking for ideas, finding great idiosyncratic ideas, whether that's buying companies whose debt is rated too low for what we think the fundamentals are, or debt that trades too cheap in the market, or there's a sector that just has great fundamentals and tailwinds, and we expect the whole sector to be upgraded over time, or if it's securitized product and we think there's great opportunities within securitized, or there's an individual bond that we think offers great risk-adjusted returns. That's how we start building the portfolio. The securities have to be selected. We need to buy individual bonds, and we have lots of traders and analysts that help us do that along the way. And then, so that's step 4. Same thing our equity managers do. We do it as well, but it's just not until we've done our top-down work. And then step 5 is just portfolio construction. That's risk oversight. That's challenge and review on the desk. That's more models looking at the entire portfolio and the correlation, ensuring there's no unintended bets in the portfolios, pre-trade compliance testing and things like that. It's more of an operational step. So that's the 5-step process. It sounds linear. It's not. We're working on all 5 steps simultaneously, and everybody on the trading floor behind me understands the 5-step process, knows where they're helping in the process, and understands that they're an important part of that process.
That's great. So I think we're kind of running out of time here. Mike, I'm going to ask you one more question, especially with the Fed meeting today. We had a question about the Fed balance sheet and what the Fed can do to kind of to continue to reduce that balance sheet, and how you think they're going to kind of make any changes or anything you're expecting to hear there.
Yeah, the Fed doesn't want they want the balance sheet to be on the back burner, and I know that got Powell in trouble in 2018, but he said it again since then. He may even say it again today. Like, the Fed reducing the size of the Fed balance sheet is something that's running in the background. They reduced the speed at which they're running down balance sheet assets, but Powell also said recently that may actually allow them to run assets down even further than they could have before. So it's still a focus for them. It's not front and center. It's not what they like to talk about. It's something that's running in the background, but I do think that the Fed continues to run down the balance sheet. I do think they'd love to have access to as much balance sheet as possible the next time they do need to cut rates. I think they like having the balance sheet as part of their toolkit, non-traditional monetary policy. So I think that's what you'll hear from them today, and I think that I think they've done a nice job in reducing the size of the balance sheet. 9 trillion. They'd love to get to 6 trillion at some point.
Awesome. Well, Mike, thank you so much for your time. I know it's a very busy time in the market, a lot of things going on, and so we appreciate you stepping away and taking the time to chat with us. And thanks everyone out there for submitting questions. I know we didn't have time to cover everything, but we do appreciate everyone who did drop a question in, and we appreciate you watching and listening and making it this far. So thanks to everyone out there, and Mike, thank you for your time.
Great. Thanks for having me.